As promised earlier today, we are going to provide you with a detailed review of what happened in the gold and silver markets in the past 24 hours. For many people, especially for those investors holding paper gold and paper silver, it was probably their worst nightmares coming true. At the market close today, gold stands at $4,195 and silver at $85. Those are huge drops from what we saw in these prices early this week. We have asked Ava to narrate an overview of the last several days and the four triggers that caused paper losses of approximately $3+ trillion.
Welcome to the Metal Market Minute. Tonight we are breaking down one of the most violent single-day crashes in precious metals in over a decade. In a stunning display of volatility, we saw gold plummet from record highs above $5,500 to break below the $5,000 level, a 7 to 9% drop in a single day. Silver crashed even harder, plunging nearly 19% from near $120 to below $100 in a matter of minutes. But underneath this panic, a completely different story is unfolding. Let's look at the numbers. This was the worst day for gold in over 13 years and the worst for silver in roughly 15 years. Most of the damage was inflicted in a tight window of just 30 minutes to 2 hours during Asian and European trading. In total, approximately $3 trillion in notional paper wealth evaporated across metals positions, mining stocks, and ETFs. The speed of this drop was historic. What triggered this wipeout? The catalyst was President Trump naming Kevin Warsh as his pick for Federal Reserve Chair. Markets immediately interpreted Warsh as a hawkish pick who would protect Fed independence, contrasting with speculation that Trump would pressure the Fed for endless rate cuts. The single personnel announcement completely flipped market sentiment. The reaction was instant. The dollar spiked on expectations of a more disciplined monetary policy. Remember, gold and silver had been driven by a debasement trade narrative, betting on a falling dollar and a loose Fed. A stronger dollar, combined with hawkish expectations, created immediate headwinds, forcing a rapid repricing of the metals. However, one headline doesn't usually cause a 20% crash. This was a perfect storm of four factors. First, we had a parabolic blow-off top where metals had ripped 20% higher in just weeks. Second, exchanges like the CME and Shanghai hiked margins, forcing leverage longs to post more capital. Third, algorithmic selling kicked in during thin liquidity, creating a cascade. Finally, the Warsh policy shock was the spark that lit this fuse. So, is the bull market over? The consensus among retail experts is no. Most view this as a classic blow-off top then flush, a shakeout of weak hands rather than a trend reversal. While this is the worst day in years, experts note it follows the strongest 12 to 14-month rally since the late 1970s. Reports from India and China indicate that despite the paper crash, the physical bid remains intact. Crucially, the smart money isn't running for the exits. Major banks like Goldman Sachs, Citi, and JP Morgan have not lowered their price targets. In fact, most have targets for 2026 to 2027 near or above $5,000 for gold, with Citi predicting silver at $150 plus. Banks are framing today as a healthy correction after a vertical move, not the end of the cycle. We also have to look at the biggest buyers in the room: central banks. In 2025, they bought over 800 tons of gold, an all-time high pace. There are no signs that this structural buying has stopped. If anything, these dips are viewed as attractive buying opportunities for nations diversifying away from the dollar. This is long-term reserve diversification, not leverage-driven positioning. Investors are suffering from narrative whiplash. Yesterday, the story was currency debasement and a dollar under siege. Today, the story flipped to Fed discipline and dollar strength. But here's the reality check. Neither narrative is fully true. What really changed today was positioning and leverage, not the underlying structural drivers like debt, geopolitics, and central bank diversification. We have to distinguish between the paper market and the physical market. Today, the paper market crashed due to margin hikes and algos. But the physical market, driven by central banks and long-term accumulators, is still buying. If physical premiums blow out while the paper price drops, it signals that real demand is still strong despite the paper weakness. As the dust settles, here's what to watch technically. For gold, key support tests are likely between $4,360 and $4,550. For silver, the $100 level and potentially $90 are the critical zones. Watching how price reacts at these levels will tell us if this is a buyable dip or a deeper correction. So, how should you position yourself? If you are a long-term stacker, history suggests looking at this as a sale in an ongoing bull market. And if you are a trader, today was a brutal lesson in position sizing and the dangers of leverage. And for newcomers asking if this is an entry point, remember that big banks view dips as attractive opportunities in a structural bull run. The crash was real. The fear was real. But the people who bought gold at $3,000 and silver at $30 didn't panic sell today. What sold today was leverage and fear. Stay calm and remember, in powerful bull markets, violent corrections are features, not bugs. The structural story of de-dollarization hasn't disappeared overnight. Back to you, Paul.
Thank you, Ava, for that detailed report on the past week and our Freaky Friday today. As we always say, this is never given as investment advice, only news reports and educational information. Always consult your financial advisor before making any investment decisions. If you are looking to purchase gold and silver, we would like to recommend you look into Money Metals Exchange. They are a US-based full-service precious metals dealer, offering a range of options including gold and silver, IRA accounts, and secure vaulting services. You can find their link in the comments below.